stop guessing where the Bitcoin price is going and start looking at the math. The data is telling a story that most people are completely missing. Plan C is back on Bitcoin for Millennials. He's a quantitative analyst who has spent the last 5 years obsessing over the mathematical models that actually drive the Bitcoin market. In this episode, we're going through a lot of slides, walking through his latest research on the power law and why the traditional ideas of halvings and bubbles are being replaced by something much more predictable. And wait until you see his risk signal indicator. It completely flips the script on when you should actually be worried about a market top. If you're enjoying my content, it would mean a lot to me if you could subscribe to the channel and like my video to support my journey. Thanks a lot. All right, let's dive in. All right, Plan C, welcome back to Bitcoin for Millennials.
Yeah, thanks for having me back. Looking forward to the conversation, and yeah, a lot to share. So excited for the talk for sure.
Yeah, me too. Like, I mean, I'm not a chart or price guy whatsoever, but I like to get updated from time to time. I know the audience likes to get updated from time to time. Previous episode was with Checkmate. So I think people will appreciate your work. As some people might know, or if they check out your previous episode with me, you're also very deep into all the power law stuff and the quant stuff. So, you're here to show what you found recently, right? And then, I'll just ask the dumb questions, try to clarify everything that doesn't make sense to be in.
Oh, yeah, absolutely. Interrupt whenever and ask whatever you want. And yeah, together we'll do our best to convey the information here.
Let's do it.
Yeah, let's get into it for sure. Do you have much thoughts on, like, I guess, about this whole idea of the business cycle actually being one of the true drivers potentially of the Bitcoin cycle, or one of the biggest kind of headwind, tailwind, so to speak? Like, it's not the only driver. There's, multitude of things that influence Bitcoin, but it's one of the more kind of proven statistical drivers potentially.
Yeah, well, I think this is probably what connects Bitcoin to perhaps a bit more of a classic economics take, right? Where you have waves in liquidity and business activity, etc. Right? Because the PMI, I think it's something about it's purchasing manager index, right?
Yeah,
so
yeah,
it is about like is money actually being spent by businesses buying other products and services, right, to run their business, basically. And so in essence, for me, I agree with this idea that Bitcoin is a asset that is tied to liquidity. And so, in that sense, I understand that this is something you would look at. I think what is more interesting is that it actually connects, right? So I'm not really sure what that means in a broader sense, right? Like, okay, there is more liquidity, people are spending money. How do you tie that to each other? Is it more about the amount of liquidity, or that, for example, the economy is doing good or bad according to this index? Like, what would be the more like qualified way of describing this?
Yeah, like in my opinion, it's essentially like an aggregate kind of indicator for how well in general the average person and society is doing. Like, is there a lot of money flowing? Are people buying new things? Is there kind of transactional movement of and liquidity, you could say, or movement of money? So it's just kind of an overall indication that things are expanding or contracting, right? So then that's kind of the concept behind the index. Is over 50, you have expansion. Under 50, you have contraction. And so this kind of has like these, over the course of the entire index, you have different lengths of time for these cycles to play out, but they're typically like 4, 5, 6 years, 3 years. Like, there's kind of in that range of like 3 to 6 years. So, the last few years, though, they have been very much 4-year cyclical cycles. And so that just happens to kind of coincide with this 4-year cycle idea, right? And so, and there is a way of actually looking at the correlation mathematically. So, and it's actually a strength of relationship. We can get into that. But the point is, that's how I would define it. I would simply define it as, businesses, inventory, they've got more orders, things are flowing, things kind of are going well within society in general. So to a point, right? And then it's not the be all end all. That's the key here. It's one clearly correlated either headwind or tailwind, and then we have other types of macro influences because macro is like a combination of a lot of things. The backdrop of macro, and that's kind of the idea. Is like Bitcoin goes through its natural psychological kind of boom and bust on its own, but it's within an overall landscape where you can have more, you could call it like bullish or bearish, backdrop, right? And so this is important because we've never actually finished a full bull market, completed a full like euphoric bull market when the index has been below 50 the entire time. That's never happened in Bitcoin's history. So the index has been below 50. You'll see it on the next few slides. It's been below 50 for the last 3+ years. So we only went above 50 the last 2 months because it comes out monthly, the information, the data. So the last 2 months did we break above 50. The entire quote unquote bull market we've had the last 3 years was with a backdrop of the business cycle being in a contraction. So that's unique. That's never happened before. And so that's something worth noting. And me and Sminston have this phrase we're saying, like, this bull run we had or whatever we're still in or however you define it, it's like a pseudo or a quasi bull market, right? It's not the same backdrop we had in previous cycles where we went full kind of euphoria and there was everything aligned, with expansion to give us that complete bull market. That's why I kind of felt a little different. So that's kind of my kind of working theory on it.
There might be people that change their perspective from Bitcoin being risk on to Bitcoin being risk off. That's kind of what I take away as perhaps a possibility here, because my bigger idea would be that over time, more and more people would actually figure out Bitcoin is a risk off asset. So I wonder what you think of that.
Yeah. Actually, my opinion on that is that Bitcoin is both, and it's always been both. But it's over time, it's evolving to have a higher percentage weighting of one or the other. So I think it's both risk on and risk off. But over time, its trend as far as the weighting and the influence of that is more risk off, but it is still very much risk on. And so it depends obviously on who's buying Bitcoin, right? There's a whole spectrum of wealth, and so for the people that they're looking to diversify, they have a ton of money. Those sorts of people, the small allocations, they could be risk off. They could look at it as risk off, right? They have excess capital. They're going to buy. They're not as affected by, they're not the average household in America that's during a contractionary phase is penny pinching and can't buy any additional, assets or speculative things. That's kind of like the risk on, a consumer, and that's a different weighting, and so I do think it's both is kind of my take on it, and to your point, as far as like putting in an all-time high in a contractionary environment, I mean the ETF, like there was so much kind of like big adoption news and vehicles to access Bitcoin, so I think it was more opening the door to lots of different ways that people could buy Bitcoin and get involved with Bitcoin that they couldn't before. And so I think that was a big part of the rally. Plus, we had Trump. Everyone was so bullish, thinking like Trump was going to, buy Bitcoin for the US, crazy amounts of, this whole strategic reserve idea. So I think there was a combination of really bullish narratives that basically propelled us. And then, also, along with this 4-year cycle narrative, the 4-year cycle narrative is a powerful psychological self-fulfilling narrative. Now, I don't think there's actually anything to it other than that. I think it's completely psychological and self-fulfilling, which is a powerful driver in and of itself. It's not to be disregarded. I mean, I've run lots of polls on my X account where like 50% or like at least a third of people strongly believe in this 4-year cycle idea and trade it. And so come Q4 of last year, it was a big headwind. And you also had a lot of these OG sellers. So we had a lot of old OG coins coming back on. Like Checkmate does a great job of explaining that in detail, how there was clearly on chain a lot of OG coins coming back into the supply. And so that was obviously a headwind. And then on top of that, you had a combination of things, really. You had the 4-year cycle narrative, which everyone's like, oh, this is the end of it. Everyone sells here. And we, we buy back in a year at the bottom of the bear market in a year. So you had that, and then you also had this Binance, black swan, quote unquote, glitch that happened with Binance, where you had like 20,000 in cascading liquidations, right? So that was obviously took a lot of the wind out of the sails for the cycle with that, and brought us down, I think, a lot further than we might have gone. Plus, then you have this Jane Street. Who knows what's going on with that? Potential months of manipulation. Maybe it happened, maybe it didn't, but there's a lot of smoke there. So you have a combination of a lot of things to kind of get us down to these levels.
When it comes to holding Bitcoin securely, peace of mind starts with architecture. On-Ramp's multi-institution custody model distributes control access across 3 independent regulated key holders in a 2 of 3 multi-sig quorum. No single point of failure, no pooled or omnibus exposure, just segregated client-titled vaults. You retain full legal ownership while On-Ramp coordinates security, compliance, and operational workflows behind the scenes. Multi-institution custody is the foundation for everything that On-Ramp builds. Sound infrastructure that distributes counterparty risk and provides fault-tolerant resilience with clear audits and institutional controls. And now On-Ramp is piloting flat, predictable pricing to make best-in-class Bitcoin custody and financial products more accessible than ever. Visit onrampbitcoin.com to learn more and sign up with code BRAM, that's BRAM, to receive $150 in Bitcoin after your first deposit. On-Ramp, strength in many, simplicity in one.
So yeah, you can see it here just visually, right? So basically the last 3 years, we barely poked our head for 1 month above 50. We got like to 50 and a half. It wasn't, you might as well say we didn't go above 50. Now we had a huge spike from 48 to 52 and a half in January. And then this last month, we saw follow through very similar. So we did have a big jump above it, the most meaningful jump in the last 3 years. And so the question now is, are we going to get follow through? And are we actually going to go into more of a, expansionary part of the cycle? We're definitely overdue for one. I mean, being 3 years below it is the longest in a long time. Like it's so we're definitely due to have mean reversion where we do spend some time over 50, and you can see the last few cycles we got well above 55, kind of between 60 to 65 range. So we're at around 52 now. We could easily see an expansion to 60 to 65. That would be kind of on par with all the previous cycles we saw. So we'll have to see. It only comes out every month, but that's basically what I'm watching for, is like, is this a head fake? Are we just going to go above 50 for 2 months and then crash back below for another 6 months or a year? Or is this actually going to be the expansionary part of the cycle? Yeah. So this one here is just a zoomed in version. And credit again to Sminston With. He's the one that put these specific charts together. We did a lot of the analysis together, and we've had a lot of discussions about this, but he's a phenomenal analyst, and he's the one that actually created these specific charts. So credit to him. But this is showing more the trend, right? So over those 3 years, when you zoom in, you can see there was this like steady up kind of like grind pattern, you could say, to the right, like a slight increase, and then we just had the big jump the last 2 months, right? So it's just kind of showing that even though we were below 50 for the last 3 years, the pattern was kind of like a slow, gradual expanding, or kind of getting back to, I guess, baseline more so. Even though it was a full 3 years of contraction, there was a slow up trend, right? And we kind of broke out of that even higher to the upside. So that's kind of the main thing we're showing here. And you can see, when that happened last was actually right before the last Bitcoin bull market, right? You can see that big jump above 50, right? In a big way. That kind of happened. I mean, there was a head fake, in 2020, you can see there's like a head fake on the chart. We got a little bit above it. And then that was a very small above it. And then a big crash because of what happened in 2020. And then but the big jump where the green arrow is, that's like the clean break of 50, right? So assuming this is the clean break, it would be the equivalent, as far as the business cycle goes, equivalent to actually late 2020. And then, 2021 was obviously huge for Bitcoin. So it doesn't mean that's how things have to play out. It was a different environment in other ways. Yes, the business cycle might look similar on the index, but money printing wise and things, that was a different period. So we got to factor in everything, not just one thing. But yeah, just worth noticing on the pattern here. And then we can jump to the next one. This is the last one on the business cycle. So what this shows is the correlation over time. So basically you have two competing narratives. You have the 4-year cycle and the halving, like, oh, it's the halving that drives the cycle. Now, early on, actually the halving did drive the cycle, but only for the first cycle, maybe the second cycle. It was a bit of a kind of a passing of the baton, so to speak. The first cycle, the halving had a meaningful impact on supply. So there was a clear influence there. And you can see the dashed line is the halving kind of influence. It's to do with annual inflation rate percentage. So you can see, from the top left corner to the bottom right corner with the dashed line, you can see the dropping of the influence of basically the halving as an influence on the cycle. And then opposed to that, and opposite, right, you have the business cycle, which its correlation just growing over the entire period. Now, the business cycle wasn't a very highly correlated influence until about 2016. It was around 2016 and actually the second halving, or just before the second halving, you could say, where kind of like mid 2016 is actually a better way to say it. That's when the influence of the business cycle kind of took over, and it's been growing steadily ever since as far as its correlation. So it's gone through peaks and valleys, but the trend is growing its influence and correlation, and that's what that line shows. That kind of greenish bluish line, it's showing basically higher and higher correlation as the halving becomes less and less impactful.
The adoption of Bitcoin is a 1-by-1 conversion of people that realize, money is being debased into perpetuity. So I have a challenge, not only today, but also towards my future, right? I need to park my wealth in other assets. And so there is there's a menu of assets that you can choose from. And then there's this thing called Bitcoin that is kind of like entering, into this menu, basically, if that makes sense. And so you have hard, quantitative data, but there's also this kind of layer of adoption, which is way more vague, right? Like you don't really know who we're reaching or who wakes up to broken money, right? And chooses Bitcoin. So where, like you said, the halving had impact before and less later, I think it's also because there is just there are more people that are also buying Bitcoin and using it and also holding it over a longer time, etc. Right? So I think it's very interesting that there is also this layer that is less quantifiable that you can kind of put on top of that. Does that make sense, right? Like there is a certain cadence to the adoption, but you cannot really define it. But you can only define it perhaps in time, right? So, Lindy effect or whatever, like just the whole idea of, okay, if Bitcoin still survives, it keeps on doing what it's doing, then logically more people would adopt it and you will kind of see something like this.
It's becoming like Bitcoin's becoming a more stable network over time. The volatility is kind of trending down over the long term.
Like it appeals to more people, right? Like the pie of people that could use it gets bigger.
Exactly. Well, it's become more, the confidence goes up the longer it's around, like the Lindy effect kind of concept, and the stability and the vehicles to access it becomes more credible. It's like the market cap grows. So this is naturally just part of any kind of adoption cycle, adoption curve, you could call it. There's definitely this underlying kind of adoption that's occurring with Bitcoin over the longer time frames. And that's where a lot of these mathematical patterns, come from. Combination of the hash rate growing, miners growing, as well as just overall adoption as some of the drivers behind those patterns. So adoption is a huge impact, and I mean we see it every cycle. More news related to different types of adoption signals for Bitcoin, right? It kind of gets to the next. It kind of upgrades itself, as far as its impact and with market cap, etc. But as far as specifically to wrap up on the concept of the halving and the impact. So there's just the mathematical reality that every 4 years, its influence is decreasing, right, as a percentage. So you have lower and lower amounts of coins coming onto the market via mining, right? So it doesn't make logical sense. Like there's absolutely zero logic behind the stock to flow model. I hope people understand that. Like it's a complete bankrupt, but there's no logic behind it. It's completely bankrupt. So because when you think about it, why would the inflation rate going from, say, just as a number, 0.5 to 0.25 cause a 10x in the value of Bitcoin. That there's no logic to that. Like that small difference in the releasing of coins, right? We just saw Saylor buy 18,000 coins in a week, right? So like we have 450 coins released every day through mining. So why would, the next cycle it's going to be half that? So like that small difference of, we have inflation of 0.5 versus 0.25, like why would that cause a 10x higher market cap on a model? There's no logic. Anyways, I don't need to go on about that. It's just the stock to flow model, just so people understand. And it's nothing against Plan B. Plan B is a net positive of the space. I think he brought a ton of people in, and those people have educated themselves. He made a very good attempt at a model. I mean, the idea of scarcity, I get it. Bitcoin's like a 21 million cap supply. It's a big part of the narrative of Bitcoin is scarcity. So I can understand like wanting to model that. And I think he's an absolute net positive. So don't get me wrong. But the model itself, if people are following it, they're going to be perpetually disappointed, because the average price for the stock to flow is supposed to be 500,000 between the last halving and the next halving. And the standard deviations are between 250 and 1 million. So what's the likelihood that the average price is 500,000, over this 4-year window? We've already gone through multiple years of, we're already over halfway, I believe, in the 4-year window, or like getting close to that. So, it's just not going to happen, unfortunately. The only way stock to flow holds is if the US dollar goes into hyperinflation and completely breaks, right? Which I don't think it's going to in the next 5-10 years. Like at, maybe 50 years down the road, 25 years or something. It's possible. But as long as the denominator stays reasonably stable, it's just, that's not the model that's going to play out. But I hate to burst people's bubble. I mean, it's a hopium model. I mean, it would be amazing if it played out that way. I would love to be wrong on this. I mean, I would be thrilled, if
it would be entertaining.
I mean, I would love to be like egg on my face, but my Bitcoin's worth, way more. I would love that. But as somebody who just is kind of obsessed with analyzing things in a very logical person, like I just can't get my head around why this model has become so popular. It's very kind of surprising to me. But anyways, this one, I like.
I like this one.
Yeah.
Wait, I'll share why. Sure. Sometimes I'm in the trenches of LinkedIn, and you see these people saying like it now costs more money to mine a Bitcoin than what the price is, and blah blah blah, and it's all going to shit and hell. It's all the doomers are coming out when we have a little drawback. So, by the way, but this is a big argument of the critics. So I wonder what you have to say about this.
Yeah, I actually think this is one of the more interesting things related to mining, not the halving itself, but the actual cost of production. So the cost of production, there's been different charts flying around over the last month or two about cost of production, people trying to say, well, what is cost of production? Like, how can you determine it, and how important is it? So in my opinion, it's actually extremely important, because Bitcoin is a global digital commodity, right? You can look at it in different ways. It's a commodity, and it is tied, it's an energy currency, it's a network, it's multiple things. It's not just one thing, but it is definitely a commodity and a digital commodity. So being that it is, the interesting thing about commodities is they only trade below their cost of production a very small percentage of the time. In some assets, it's like 1% of the time. In others, it's 5%, but it's not really more than 5%. So it's actually very rare for an asset to go below its cost of production, be it gold, oil, or whatever it is. That's extremely rare. So why would Bitcoin be any different? I mean, going below the cost of production, yes, Bitcoin has this dynamic where the difficulty can adjust as some miners become not profitable, right? Some miners, they're not profitable, they have to turn off, or they go out of business. This happens every cycle. It's completely normal. People always create FUD and doom and gloom around it. It's so cyclical to see, but it doesn't matter. I mean, the network is set up in a way that the strong miners, the ones that are efficient, they'll survive, right? And they'll basically get a bigger piece of the pie, and the ones that can mine at lower costs, right? But this model is based on the average aggregate cost of production. So we don't actually know. Nobody knows the exact number. It's actually unknowable, because about a third, roughly speaking, about a third to 40% of the hash rate is from US public companies. If every single company that mined Bitcoin and like all the hash rate was public US companies or publicly traded companies, you could actually figure out the cost of production with Bitcoin. You'd weight it based on how much hash rate each one has, what's their total net cost of production. They have to disclose their energy costs and these sorts of things to investors. So you could actually get that number. But the reality is a lot of the network is in parts of the world where people are mining in an opaque way where you have no clue. You have no clue their costs. So we don't actually know the exact number, but we can definitely approximate it in a band and a range. And this specific model was put together by a guy named Paul. I wish I had his account. I should have had his account ready, but I've shared this a couple times on my account. I've talked to him numerous times. He's a really nice guy, but he's focused heavily on actually using issuance and difficulty, and then he created essentially a formula around it to create basically a band, right? So the top chart is zoomed in there. You can see, it's kind of honed in on a specific number, but it's actually a band, right? So you got to add like 10%, you could say, in both directions. And so you can just see visually, right? Like the bottom chart there, is the higher time frame model. We bounced off that band, so many times throughout Bitcoin's history. And even recently over the last, 5 years, 6 years, you can see we bounced off it multiple times, right? So it's worked as a kind of like an approximation for, okay, we're fully deflated. Like the cycle itself is fully deflated. All the euphoria is gone. We're back at the cost of production. That's kind of like the balloon is fully gone. Like there's no bubble kind of concept, right? And so that kind of range, it's very rough, right? It's hard to approximate it, but it's between about 50 and 65,000, roughly speaking, 50 to 70, 50 to 65. So that's the average cost. Right now, you have some miners that are mining for 35, 40 probably, right? But others that are higher. So it really depends on the cost structure behind every miner. But generally speaking, we're down to the band around where the average miner is roughly cost to produce, right? And so that's noteworthy, and that's really the key takeaway here.
If you live in a multipolar world where the jig of fiat money and exporting inflation, etc., is up, and you need a decentralized store of value and medium of exchange to actually trade with each other, and you are a country that adopts Bitcoin, you are forced to contribute to the hash rate for your pure self-interest, which, this is one of the most brilliant things I think about Bitcoin, right? It's for your self-interest that you contribute to this hash rate. So you can make sure that your transactions always go through because you mine your own transactions always, right? But the fun thing about Bitcoin, right, and Jeff Booth calls this cooperative competitiveness, you never know who else's transactions you're also mining, right? So you could be mining the transactions of your adversaries, which is the whole point why Bitcoin is for enemies. So I'm fully aligned with this way of thinking. And I also think that this is where it's going. Like, you cannot adopt Bitcoin as a sovereign nation and not contribute to hash rate. Like that then you
I think it's essential. And I think it goes along. The mining is one aspect, but then you're going to see also like multiple layers when it comes to the security. So you have the mining, a lot of big countries and individuals supporting the mining, but then you're also going to have the same with just securing the network in general, like when it comes to cryptography and everything, upgrading to be quantum resistant. All those things are going to be solved because there's going to be so many, such an incentive with these, Sailor's going to have 1 million Bitcoin before we know it, and Bitcoin's going to be, back well over 100,000 before we know it. And so that's a large amount of capital, like, over $100 billion, and that's only going to grow. So there's a huge incentive to obviously, figure out ways to secure the network. And so that's just going to be a process of time. I'm not overly concerned about that. And so I think the mining, any kind of mining worries over time, they take care of themselves. I think they really will. Same with the whole quantum. We don't have to go down that rabbit hole, but that'll take care of itself over time as well.
For my European friends that want to buy Bitcoin with ease, check out Relay. I've been a longtime fan and happy to partner up with what I think is the best Bitcoin-only platform for Europeans. They offer a super simple, beginner-friendly app with no distractions and no shitcoins. You can do a quick one-time smash buy or set up automatic purchases when you're stacking regularly. And here's the thing that matters most. Relay is 100% self-custody. Every set you hold is yours. Your keys, your coins. If you want to get started, download the app via my link below or in the description and use code BRAM, that's BRAM, at checkout to get 10% off your fees. A huge shout out to Relay for sponsoring the show. Now let's continue.
So this is a completely different lens, and it actually, the confluence between this model and then the cost of production is you can see with the numbers, they're around the same levels. So there's actually a lot of confluence around these numbers. Say you're buying at like the 10th quantile, and that number is probably more like 67K right now or 68,000. So if you're buying at the 10th quantile, you know that 90% of the time, it's been a worse buy than that point. Like 90% of the time, the price has been higher. So you can say like, I'm getting, my buy is within the best 10% of the period of Bitcoin's history, right? It's a way of looking at it, right? Assuming the long-term patterns hold. So that bottom blue band there is the bottom 10% of the distribution. So it's the bottom 10%. And basically that range runs from about 55 to 67 right now. And like I said before, the cost of production, 50 to 70, roughly speaking. Bottom band, deep value for the quantile model, pretty much a map of that, right? Very similar. And so I do think this kind of long-term power law pattern on the math, I think there's a strong connection between the kind of like long-term power law pattern is a network gaining stability, but it's also cost of production and its adoption, like you said. So they all kind of go together. But this kind of shows like there's other things, right? So we have the statistical lens, we have the cost of production lens. You can also look at the TA lens, technical analysis. The 200-week moving average, that's sitting around 59 right now, right? We've bounced off that in multiple different cycles. Now we did go below it last cycle because of the FTX Black Swan and the Ludo Black Swan. So it's not like we can't go below the 200-week moving average, but generally speaking, that's a pretty low point in any cycle when you get to that level, and that's at 58. Right? Then you have the RSIs. They're all kind of bottoming out. The higher time frame RSIs like the weekly, 2-week, 3-week, those are looking similar to kind of all the bottoms of the previous bear markets as well. So there's a lot of confluence kind of saying like, of course we could always go lower, a bit lower, but we're in that kind of range where you're like, oh, if 60,000 was the bottom, like it wouldn't be that surprising to me personally. Like 60% would be 50,000, right? So for me, that's kind of like my still worst case, so to speak, right? Because the first quantile is at around 55, like I said, and we spend 1% of the time below the first quantile. So we could go below that. Like it is possible to go down to like 50 or something, right? Obviously, anything's possible. Everything's probabilities. No one knows for sure. So we could always go lower. But like I said, the odds of going lower than that become diminishing and very small. This is analysis. I won't go into the weeds of this. I'll just give kind of like the takeaways. What I did here is actually, I think it's really cool and really in depth for the people to understand it. But what I did is that bottom blue band, I took the bottom quantile and I said, I'm going to run 522 snapshots every single week for the last 10 years. So what I did is I basically took the exact math behind that pattern, the slope and the intercept they're called, that creates that kind of pattern mathematically. And I said, how stable is this pattern? Right? Is this just moving around? Because some people think like, oh, these quantile bands, they just jump around and it's just, whatever. They're just going to go wherever they need to go to make the model still look good. It's actually not the case. So this one is comparing actually, I think the audience will find this interesting because anyone that follows the power law, kind of knows that it's price versus time. So it's modeling price versus time in log space. And in that space, what's chosen as the time component or the time variable is since the Genesis block. So everyone's always used the Genesis block and they always thought that was the best to use. It was kind of this assumption that was never actually proven with statistics or people didn't really look into it in depth. Now people are starting to, myself and a handful of other people are actually starting to question like, why are we using the Genesis block? Why does it have to be the Genesis block? And so when you compare head to head, different start points. So this is showing April 5th versus Genesis. There's actually the first quantile is 3 times more stable when you use April versus the Genesis block. So there's actually a meaningful difference in the stability of the model. You can just see that in the lines. So that bottom green line is the first quantile stability when you're using April as your starting point, April 5th. Mm-hmm. Now, it doesn't have to be exactly April 5th, but like kind of 3 months after, you could say after Genesis, if you kind of start time 3 months later than Genesis, you get 3 times more stability in the model. That top band there, or the top on the chart, the kind of I don't know, orange line, you can see it's not as stable, like visually. And there's a wider range of the parameters of the fit for the actual the bottom quantile. So I just wanted to show that basically the stability of the model is a lot better when you actually change the start date. And for people that are saying, well, you have to use Genesis, right? There's kind of this idea of Genesis has to be the starting point. My opinion on Bitcoin is Bitcoin did not start. It wasn't like a light switch that turned on or off. You didn't have Bitcoin that just, today there's no Bitcoin, tomorrow there's Bitcoin. Bitcoin was a year-long process, and people that don't know the history of Bitcoin, there was multiple very significant events that occurred between the white paper and the first time Bitcoin was exchanged for US dollars. So the white paper actually came public. So the concept of Bitcoin came into the public sphere on October 31st, 2008. October 31st, 2008. So that's when the white paper was written. Then you had, Genesis. Then you had these multiple other key events, right? Second node, first US or first Bitcoin transaction. But the US, the first time Bitcoin was traded for US dollars was October 12th, 2009. So almost exactly a year later, from the white paper to the first time Bitcoin traded for US dollars. So that's a year-long window where I actually analyzed every single day in that window through multiple lenses, stability, out-of-sample fit. And I basically, a lot of the indications are pointing towards this kind of roughly 3 months after Genesis being the optimal point. And that point is exactly in the middle, almost exactly in the middle of that 1 year window. So instead of saying Bitcoin started when the Genesis block started, that's when the blockchain started. But Bitcoin as a larger thing was a year-long process, and in the middle of that process happens to be the best starting point, right? If we don't, and people want a specific day, they want a specific significant event. The significant event was a year-long process where multiple things happened, right, along the journey, right? And because when Bitcoin first launched, the Genesis block, it was on Satoshi's computer. It was basically a data set. It wasn't even a second node at that point. Like, it wasn't Bitcoin, and it wasn't even close to being traded for US dollars. No one was even mining it. So to me, the US dollar to Bitcoin transaction is arguably more significant because we're modeling Bitcoin versus US dollars. Like, that is the model. Right. And that's when the first, so I don't want to go too much into the philosophy. I just want to show you that when you look at the data, it's very hard to argue that Genesis is the optimal point. So I'll show you the next, we can jump into the next one. So this actually, again, shows it. So again, I looked at all the start points, 347 start points for the model. April 6th ranked number 1 for this specific out of sample data I was looking at for the fit. Genesis was 238. So it's not even in the top half of the most optimal start dates. It's actually one of the worst, and for multiple reasons. So we'll show it in the coming charts in more depth. But basically, it fails actually on multiple levels. The model itself is not calibrated. The wrong amount of data points fall below the quantiles. So it's actually failed in multiple ways, and I can show this. And that's where people say, like, oh, those fits just drift. Well, they only drift if you're using Genesis. They don't drift if you're using other start points. But yeah, we can jump to the next one. So this is the out of sample data. So this is not just like, oh, people are just like, oh, you're fitting curves. This is just in sample data. You're just trying to optimize for R squared, goodness of fit. I did this analysis with 9 to 12 years of training. And I basically looked at the first quantile and I said, how well does it predict the rest of the data set? So this is out of sample testing. And you can see the white paper is not the best point to use. It's actually the worst. So interestingly, the white paper is the worst. It gets progressively better.
So it's mapped to actual eventual price data, right? So the point here of getting to the best representation of the data, exactly, right?
The model,
exactly. So that's
the model is the best. So there's two main criteria that I use. One was stability of the model, because if you're going to have a model that predicts anything into the future, like 1 year out, 5 years out, you need the model to be stable. It can't be drifting. So I used stability and I used accuracy. because I did out of sample testing. Out of sample testing, you basically take half the data set or 2/3 of the data set, and you see how well it predicted the rest of the data set, which is the gold standard for any model. Does it actually work? Does it actually predict things?
So you basically emulate that there are days where no price was recorded. Basically, it's kind of
as far as the model knows, it doesn't know that the data continues after 2020. I stopped
the analysis. The only data that exists.
And I said I stopped in 2020, and I said how well did it predict the last 6 years? And I did this for every single. I ran this like. This took like a day to run on my computer. I don't have some crazy computer, because it went through every single day, and it went through all these different metrics, right? So
and then you project it to the future and then see if it is correct.
How accurate was each starting point? So I did the same model, everything else the same. I only changed the starting point, right? You only can change one variable. I only changed the start point. I did the entire year window, and I looked at how well did it predict the last 6 years, and basically you can see it there, right? You can see the white paper was horrible. It got better towards Genesis, but it got a lot better 3 months after Genesis, and then it slowly tapered off as you go further out. First USD transaction is that October 12th, 2009 date. So that's that full window of time. So this is, again, and I looked at it through stability and accuracy. Those were kind of the two main things. And I was searching for what is significant early April, like what Bitcoin events have, and it's April 5th or 6th is actually Satoshi's birthday. So that was just a fun.
Really?
Yeah, there's no connection. There's no reason why, that would make it the best fit. It's just a fun kind of one of those synchronistic, universe laughing at you kind of things where it's like, well, that's just a fun, odd coincidence that Satoshi's made up birthday, because his birthday is obviously not a real birthday. He made that up. It's kind of a play on multiple things, his birthday. People can look into that. But Satoshi's birthday is actually very meaningful. He chose a specific day for a specific reason. And it was actually based on a message for people that know that. It was to do with like gold confiscation and different
6102, right?
Yeah, there's exactly. So there's a lot of significance behind Satoshi's birthday, and his birthday is like, I think it's April 5th or 6th. So that was a fun kind of coincidence. But for me, again, it's more the year-long process, and this is like in the middle of that year, and that's, there doesn't have to be anything meaningful. It's just, this is the best, way to do the model. I mean, if you, if you care more about the philosophy, maybe use Genesis, but if you, or not even philosophy, but if you're tied to that narrative or idea, okay, great. But I want to have the best model. Like, that's my goal always, is kind of figure out the best way to approximate the future, essentially. So this shows it even. I think this is the best chart to actually explain what I'm talking about and the significance of it. So that bottom colored band, or the bottom colored line, that's if you use April 6th. The top one, the red one, is if you use Genesis. Now, what I did with this specific chart is I did that out of sample testing I was speaking about. So I took the first 2/3 of the data set. When you're doing time series analysis, which is what this data set is, it's price versus time. It's called a time series. The gold standard for out of sample testing is to take 2/3 of the data set, the first 2/3, and try to predict the last third and see how well the model does, right? So I did a very straight comparison between these two start points. Everything else is the exact same. And I let those two project out, right? I didn't change anything, because what you do is you take the model at the 2/3 training point, and you take the parameters and you take kind of the math behind it. And you say, okay, project it out. Let's see how well these do. This is again for the floor. This is the first quantile for both. Now you can see there's a huge difference, and it's actually pretty significant, because I would argue that the Genesis version of the power law model is actually, to a large extent, it broke twice. And the reason why I say that is because 12% of the data for the last third of the data set went below the first quantile. So 12% of the time we were actually below that first quantile. By definition, we should only be below it 1% of the time. So we actually went quite a bit below it during FTX, and then we actually went below it recently, because when you project out the red line, which is Genesis, it's saying today's first quantile should be at 74,000. And the reason why the quantile is now at 59,000 is because the slope had to drift lower. So the model had to adjust and correct lower. And that's where there's criticism around modeling. People say, well, with quantile analysis or power law or whatever, these models just adjust lower. Well, they're correct. Actually, the Genesis version did adjust lower multiple times over the last 6 years to stay relevant. But if you don't allow it to project lower, then the floor actually broke during FTX and recently. Whereas the April start, you can see it nailed the FTX bottom. We didn't go below it, and it's projecting now at 55. So one model stayed consistent the whole time. The other one had to go from 74 down to 59. So basically the Genesis one is correcting towards the April one, if that makes sense. This is another optimization that I spent quite a bit of time on, and I'm actually the first person to talk about this. So Bitcoin's power law, and this is going to be a little harder and abstract for people to understand. I'll try to make it as simple as I can with analogies. So basically what you have is Bitcoin is a power law, but it's a very unique power law. There's lots of different types of power laws that exist across all sorts of scientific fields, but Bitcoin is very specific and very unique. It's in a small class of specific power laws because it's using time as a variable, and basically it's measuring on the x-axis with time. So there's two inputs, one of them's time, and then you're measuring in time. And so what that does is it creates compression. So the data points come in, and because you're compressing them with log, you have what's called a density bias, where all these data points on the right side get clumped together. And what that does is it actually bias more recent data. So the data, the model itself is not evenly weighted as far as its influence. Now, to explain this in like a super simple analogy, imagine 10 people walk into a room. Normally, you'd say, well, everyone that entered the room should get one vote. Say we're going to make a decision. Okay, everyone enters the room, 10 people enter the room, everyone gets one vote, every vote is even. Well, the way the data is set up right now with Bitcoin, because of this log compression, if you don't adjust for this, what happens is it's like every person that enters the room, the person that entered last gets the most votes. So it's like the 10th person that came in, we're going to give him 3 votes or 5 votes. And then the person that came right before them gets 4. Like, clearly that's not the most optimal way to kind of get an even representation of the data. And with the power law, one of the core philosophies around the power law is it's a scale invariant network. Basically, as Bitcoin scales up over orders of magnitude from like $1 to $10, $100, $1,000, and so on, as it scales up, it's basically doing it in a self-similar way, right? It's kind of this network that's growing in a similar way. Well, you have to evenly weight the data in order to do that, all time periods. So the bottom right corner is basically after you do the adjustment. You can see that all the time periods in log time, which is what the model is, they get even weighting. Now, if you don't do that adjustment, right, then you have that left bottom corner. You can see the brown one where the influence is more heavily weighted to more recent data. So basically what the adjustment does, it's a mathematical adjustment, and it's well accepted basically to adjust for these sorts of specific types of power laws that are using time compression, things like this, is that left corner goes to the right corner. And so when you do that, the model actually becomes way more stable because and that's basically the closing point here, is that when you have that heavier weighting because of what's called the density bias, as new data comes in, the model moves around, the parameters move around because they're reacting to that new data. So the new data has that like magnet that's pulling around the fits. When you evenly weight them across all the time periods, everything's more stable. The predictions are more stable in the future. The model's more stable. It's more correctly represented. So that's this fix that I'm proposing that people look into. The people that, again, I'm speaking a little bit to the nerds here, the people that love to kind of put together their own models, investigate this concept, right? This idea, and it's worth considering. And I think a lot of the main analysts that look at Bitcoin will switch over to this once they understand it. So last chart here. So what I did with this, again, a very nerdy thing, but what I did is I basically said, people talk about, fair value for Bitcoin or the trend value being around the middle of the data set, right? So when people talk about power law, they might use something called an OLS regression, also known as a mean regression or an average. So they kind of like in the middle of the data set, that's that 50th quantile. So what's that at today? Well, if you're using Genesis and you're using an unequalized time, like the way everyone's doing it right now, for the mean, the average, you get 125,000. It was kind of like the quote unquote fair value. If you're using the quantile, you get 119. So just say between like 119 and 125, right? Mm-hmm. Now, the problem with this though is you're not including decay. There is actually decay at the middle point. The bottom quantiles don't have that decay. The bottom quantiles are just a straight line with no decay. All these decay functions I put on there, I just wanted to show it through multiple lenses. They all conclude the same numbers. When you use polynomials or decay functions, they're basically different ways of looking at curvature. So when you allow for curvature at that midpoint, that kind of trend value, fair value, it drops lower. So the actual, I would argue through the data here is showing the convergence around a lower number than people think. A lot of people say, well, fair value for Bitcoin or trend value today is like 130. A lot of people have that on different websites. And they're like, well, we're down at like 70. We're way below fair value. We are below fair value, but I would say these are inflated based on the math. The actual fair value, if you're using Genesis, is more like 110. So it's actually slightly less than people think. And I can come on here and spew hopium, and I can create a stock to flow saying the fair value today is 500,000 because stock to flow is saying it's actually 500,000 is the fair value today. Or I can give you guys, what I think is the true numbers and the true statistics behind it. So it doesn't mean Bitcoin's not worth more than 110,000. I absolutely think it's worth more than that. But if you're only looking through the lens of statistics in the data set, based on today, that is what the number says, right? It's one way of looking at fair value or trend value. Again, it doesn't mean Bitcoin's not worth a lot more than that for people that understand it. It's just kind of a fair value way of looking at it. And the very last chart we can jump to is the same chart. It's just, I got to show one quick thing. The next one is everything's the same. I did all the same analysis, but instead of Genesis, I used that April start point, April 6th. And I also did the even weighting of time in log time. When you do that, the numbers actually go down again. So again, I'm sorry, I'm not spewing hopium, but this is the most like hopium removed data I can show, right? This is unbiased. I'm removing any ounce of hopium, and this is just the pure math. So it's saying the actual fair value or trend value for Bitcoin today is actually 101,000.
Yeah.
So that's what the math shows. I mean, people can agree with it, disagree with it, have their opinions on it, but that is all I wanted to represent for people that care is like no hopium, no making stuff up, just based on stats. It's one lens. It's not the only lens. It doesn't mean it's the be all end all, but it's saying around 100. Now it's saying in 5 years, closer to 400,000, 375, 400. And then in 10 years, it's saying that fair value or that trend value will be about 1 million. Now, instead of, stock to flow, I don't know what stock to flow is in 10 years. It's probably,
10 million, maybe.
10 million or 100 million. I don't know what it will be, but this is saying 1 million, right? Now we're at 70K, to get to 1 million in 10 years as the fair value. That's only the middle trend line. We can go well above that, right, during bull markets. So it's not to say we won't reach 1 million before 10 years. We absolutely can. If we get to those top quantiles, we can reach it in 6-7 years. Who knows, right? But I think it's a realistic, reasonable mathematical lens that people can look to, and it does bring it down, right? If you're looking through the straight line at the 50th quantile, it's more like 1.6 or 1.7 million, right? So it is a lower number. But I mean, that's just what the data shows. So yeah, we'll see what happens. I mean, there's obviously, there's crazy amount of money printing. The dollar gets debased to a crazy extent. Dollar wise, these numbers could go higher. But purchasing power wise, it gives kind of a relative idea, right? Of realistically where Bitcoin should go or can go over the next 5 years, 10 years, whatever. But interested in your kind of thoughts as we close here.
I think the main thing for me, like I said in the beginning, I'm not the charts or the price guy, but I'm the hodl guy, right? But I think seeing this and understanding how accurate this is, and having a certain projection with a certain R squared, right? Like it gives you data and ammunition for the actual hodling, which is hard, right? So that's what I take away from this. Because
I have a good allocation of Bitcoin. It's a meaningful part of my overall net worth, a very significant part of it, and so. Maybe part of it is distracting myself, right? Like I get so focused on the charts, like I almost never look at the price. When I say charts, I'm talking about long-term models for Bitcoin and trying to understand these things at a deep level. And so, I just kind of, part of it's just healthy distraction, and I do other things obviously in my life as well. But just for that long-term hodling, kind of like entertaining myself as I plan to hold long-term. I mean, that's part of it for sure. Very last thing I'll say with the last chart is simply that, there's 12 different models that I did there with the decay and stuff, like 12, and they all came to the same number. I haven't seen anyone else do that. Like those top two that everyone uses, they're the outliers. They're the two lenses that are different than literally all 12 that I ran below. So the fact they all converged at that number gives me a lot of confidence. And again, okay, it's a little bit lower than some people think. However, it's using the most conservative model that is the most stable, like I said, and the most accurate. So it's like, okay, you have a slightly less bullish, you could say, slightly, but a lot more confidence in those numbers, right? So that's kind of the trade-off there. But again, there's other ways of looking at Bitcoin. It's not just this lens. You can look at it through adoption. You can look at it through on-chain data, HODL waves. I think HODL waves are a really cool way to look at Bitcoin because you're seeing like the psychological
the conviction, basically.
It really is a conviction metric. It's like how convicted are people that have held at different amounts of time. So I think that's like it's one of my favorite on-chain metrics. I spent years looking on-chain. I'm not just the guy that looks through statistics. I was obsessed with on-chain data for like 3 years. So I have looked into that a lot as well. But I just want to say that I really appreciate having me on, giving me the platform, enjoyed the conversation. It flew by. And thanks for everyone who stayed listening. I mean, it's, if you're really passionate about Bitcoin and you can tell probably through the way I'm talking, like this is just like yourself. This is a passion of ours, and we appreciate everyone interacting with us and giving their opinions. I mean, the comments, on X, it's just always fun to kind of get like opinions and just learn a ton from peers. Like I got all these other people that I communicate with, other analysts. We're all kind of trying to make heads or tails out of this stuff. And so I would say right now, in a way, is almost like a renaissance for the power law, where all of a sudden you have about a dozen different analysts that are questioning multiple aspects of it, of how to improve it. I'm one of them, but there's others. So I'm not the only one. I might be one of the few people going on podcasts, but I'm in group chats and different people. We're kind of throwing around these ideas. And so we'll see the progress over time. But thanks again for having me on.
Awesome, man. Well, thanks for coming on. I really appreciate it. I think it was very valuable and helpful, and I hope people listening thought that too. So yeah, let's stay in touch, and we do it again sometime and see where we're at then. So thanks a lot. I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, if you want to help me shine a light on the message of Bitcoin, please like this video and subscribe to stay connected. I hope to see you for our next episode. Bye.